Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, while investing, mutual funds have to stick with the classification of market capitalization laid down by SEBI in 2017. Now, large caps are defined as the first to 100th companies in the terms of full market cap. Mid caps as 101st to 250th company, and small cap from 251st company onwards in terms of full market capitalization. Now, this is updated twice a year by the industry body AMFI. While there is no SEBI-defined classification of micro-cap, companies that come after Nifty 500 in terms of total market cap are usually considered micro-caps. Over the one-year period, the Nifty 100 total return index has gained almost 10%. Now, compared to this, Nifty Micro-Cap 250 TRI is up 44%, and Nifty Small-Cap 250 TRI has risen 28%. Now, a lot of craze and buzz is around micro-cap space. Now, with also because of the brewing interest within the fund managers and AMC community, them launching active and passive funds in the micro-cap space. How can you as an investor navigate through all of this? Let's understand. And with me, I have founder Moneyeduschool, Arnav Pandya. Arnav, good evening and welcome to the show. So clearly the kind of returns that we are witnessing in the micro-cap space, at least what we've seen in Nifty Micro-Cap 250 TRI, it's been up 44% as compared to Nifty 100 TRI. So, is this a specific market kind of run that we are witnessing? And also talking about micro-cap, what exactly the kind of industries and space are we talking about?
Good evening, Kavita. So, the first thing that you need to understand is that there is no clear definition of micro-cap per se. Hence, it is open to interpretation, but usually as most people understand it, any company after the top 500 companies are considered in the micro-cap space. The second thing is that as an investor, the fact that this space is giving good returns, that is not a reason for you to have exposure to it. Your need to have an exposure to this space plus your risk-taking ability, that is what determines whether you should first have an exposure to micro-cap or not. And then comes the next question as to how much of an exposure you need to have in the portfolio. So these are the basic things. But as far as the overall market is concerned, it is very clear, and we are witnessing it since the last many months, how there is an overall rise in companies, especially the smaller and the mid-cap ones. And this is quite broad-based in nature, which is why you are seeing this kind of returns come from the micro-cap space. Now, as compared to the large cap or even the mid-caps, the micro-cap space is technically a very huge basket. And this is more governed by individual companies other than specific sectors and areas, because you will find that all kinds of companies within that space. This will include everything like what you see in the large and the mid cap space, which would be financials, which would be consumer discretionary, chemicals, all those things. But here, unlike the large and the mid, or even to some extent some small caps holdings, the sector doesn't determine how the micro cap performs. It is actually a mix of a varied number of individual companies which determine their own course of action and which determines how they are also performing on the stock exchange.
Right. So currently the micro-cap companies we are talking about, a lot of them is also covered in a maybe a small cap fund. Right now we have a separate passive fund and an active to be launched, but then talking about it separately, do micro-cap also have exposure in a small cap fund?
No, so definitely, if you look at the definition of a small cap fund, I mean, it is the small cap space is any company after the 250th company, which means that 251 to wherever you take it, 3,000, 4,000, wherever the total number of companies that are there. So obviously, I mean, the entire portfolio of a small cap company will not be within the 251 to 500 companies by market cap range. There are bound to be companies which are beyond the 500 company by market cap. So it is obviously, it is not only obvious, but it is very likely that a significant part or even a part of the portfolio of a small cap fund will have exposure to micro cap companies. And let us now actually clarify this thing, because even when we talk about micro cap companies, these are companies, the top rung of these companies will be those which have a few thousand crores of market cap. So it's not like that they are very, very small companies, but it will be a huge mixture. So the lower down the market cap order you go, the market cap of these companies will also go down. But more importantly, what will happen is that liquidity also is not very high in many of these companies.
All right. Let's talk about specific funds that are launched, on microcap, because one tricky aspect of this space is that investors don't have analysis or maybe research reports, because it's not on the radar of most of these analysts. Okay, but when you talk about a passive fund, what is the kind of exposure investor needs to have in these kind of funds? And because it's a passive strategy, and because we're talking about micro cap, which can be a slightly much more riskier category, but having a passive exposure can just mitigate your risk. Is that true?
So if you look at the passive fund which is already there, which is Motilal Oswal's passive fund, this is based on the Nifty Micro-Cap 250 TRI index, which is an index of 250 companies. So in that sense, the portfolio of this fund will be extremely large because it is replicating the index. So when it comes to micro-cap, it is very difficult to predict, or it's very difficult to analyze and say which companies will do well, because these are very smaller companies. And it's, if you just have a very small portfolio which is dedicated to microcaps, chances are that it could be a long period of time before, say, one or two or even any of them perform well. So that requires that if you have a slightly broader exposure, as you can see with this kind of passive fund, you are getting a bigger exposure in the market. This in some sense also reduces the risk for the investor. But the main question remains that when an investor has the opportunity of having exposure to very good companies, well-performing companies with strong balance sheets in various other categories of funds, do they actually need a separate micro-cap fund to add to their portfolio? Because when things are going well, this looks like a very great idea. It will give a boost to the overall portfolio returns. But there will be times when things are on the downside, and at that point of time, it will become a big dragger of your portfolio also. So one has to see that if, for example, you are getting an exposure through micro cap, through the small cap funds, and you will see that many of these funds have anywhere between 15 to 25% of their portfolio within the micro cap space. So if you are getting that, then do you actually want a separate micro cap fund? It might not be required, even though this is a passive fund. An active fund will have even greater risk element involved, specifically both in terms of portfolio construction as well as on the liquidity side. But this is the first question which every investor should be asking.
All right. Now, we are also looking at having active placement or active funds in this particular space. Now, if that happens, because it's a very vast space, what kind of strategy you think a fund manager might want to adopt, and how can this be replaced by a small cap exposure in your fund? Can that be done? Go ahead.
So as of now, one fund house has already filed papers for this kind of an active micro cap fund. This is the Bandhan Micro Cap fund which has filed its papers. Now, once it comes and it has an NFO and then how it starts performing and setting up the portfolio, then we know exactly how it plans to put it into action. But even for an active oriented fund, I think that whenever there is going to be an portfolio construction effort, they will have to try and look at a large number of holdings within the portfolio because of these two risks which are there. Unlike the large and mid caps, a particular sector growth is not going to drive a large number of micro caps because a lot of them are completely different from each other. The second thing is the liquidity issue. So even when you are including companies, they will have to take a very small exposure, which by its very nature, or it automatically raises the number of holdings in the portfolio. So I would expect that an active micro cap fund will have a large number of holdings within the portfolio. And if you are looking at replacing this by your small cap fund through a part exposure, that is not a bad idea because a lot of people now have small cap funds within their portfolio. This is different from having a small cap exposure through either the multi-cap fund route or the flexi cap fund route. Because from what I see in terms of data now, there are actually now nearly more folios in terms of small cap as compared to large cap funds. So a lot of investors already have small cap funds in their portfolio. Some of these small cap funds have a huge asset under management. Like for example, Nippon India has 35,000 crores of assets under management under its small cap fund. Now, this by itself will ensure that it has a bit of micro cap exposure within the portfolio also. So that itself gives you a micro cap exposure through this route. And similarly, I mean, if you look at several of these 5-6 top funds, which is the HDFC small cap fund, Kotak small cap fund, DSP small cap fund, all of them have some bit of micro cap exposure. So people already investing in small cap funds, they don't need to do anything separate because they're already getting an exposure.
Now, one very important aspect, people invest in equity through shares and also via mutual funds. Now, explain to us, how can you balance out the exposure via direct shares and through mutual fund also in the micro cap space?
So the logical idea is that you don't want to keep investing in a particular asset class through different means where the exposure is the same. So if, for example, your mutual fund is having the same exposure as what you have directly through stocks in your portfolio, it is just replicating it and it's actually increasing your risk, not decreasing it. So when it comes to the micro cap space, it is most likely that if you have some holdings through the direct equity route, it's most likely that your mutual fund might not have those same holdings within their top holdings in the portfolio. So you might have 1 or 2% exposure to maybe 1 or 2 of them if you are anyways having a large amount of direct exposure. But the main thing here is that one should look at the mixture of both your exposure through mutual funds and your direct stock exposure to see what is the total level of exposure to micro caps that you have, because it should not be that within your direct equity portfolio you are loading up on micro caps and it's good because the portfolio is doing well. Similarly, you have a higher exposure to small cap funds within your mutual fund portfolio. This increases the risk. So whenever you are looking at risk management, it's very important that you consider your entire investment in all the areas and then see what is your exposure to various market cap segments.
All right, so this was all about micro caps. Thank you so much, Arnav, for being on the show and helping our viewers with the way ahead as far as micro cap strategies are concerned. Thank you. Time to slip into a short break, but then before that, as we inch closer to the deadline for adding nominees for DMAT and mutual fund schemes, here are the do's and don'ts. My colleague Snehi giving you all the details on this.
Well, that's right. Here's an important update for all of you who have mutual fund investments and DMAT accounts. The deadline for stating the nomination for both of these accounts is on the 30th of September, which is fast approaching. All individual demat account holders as well as mutual fund investors need to nominate a beneficiary or opt out of this step by submitting a declaration form. Now, if you fail to do so, your demat accounts and folios will be frozen and you will not be able to redeem your investments. You can, however, continue to invest in the existing folios. This mandate applies to both new as well as existing investors according to SEBI. Now, you may ask, why is this being done? Now, the move is aimed at helping investors to secure their assets and pass them onto their legal heirs. Make sure to note that a nominee does not equate to a legal heir. A nominee is solely the trustee of the asset unless a will specifies his or her name as the legal heir. What would you do if the folio is jointly held? Well, in that case, the nomination requires the consent of all the joint holders. To update mutual fund nominations online, you can visit the mutual fund house's website or the NS website. So get to this crucial nomination if you haven't done so already.